that you basically are constantly trying to get a job while you have a job. And so like I would meet with probably 5 to 10 of our senior leaderships and basically just trying to like try to pitch myself to them and say, hey, next time that you get a project, please call me and put me on this project because I need to do something. I'm unemployed, but I have a job and they're still paying me. He probably hadn't had 8 hours of sleep in 7 years. Like you sacrifice yourself to be there when others need you, whether that's work or family.
Ryan is a CFA charter holder and has worked as an investment analyst for 3 years. He currently works at a private capital firm and focuses on financing large energy and renewable projects. Ryan has an atypical background. He didn't major in finance in college, and also he started his career as a consultant. We have invited Ryan on the podcast to talk about 1, how to break into the finance industry, 2, what it takes to succeed in the investment space, and 3, how much money you can make working in finance. Please welcome Ryan Delgado to the Unmasked podcast.
How did you end up getting into the finance industry to begin with?
Yeah, I think it's a bit of a winding road. I went to college, went to Texas A&M, and I thought I wanted to do something outdoorsy. I got my undergrad in forestry and renewable natural resources, and I thought I really wanted to be outdoors, work in the woods, and have a good life doing that. And then I had an internship where I worked for a timber company, and I was outside every day. It was summer. It was over 100 degrees. I ran into snakes. I ran into bugs. I got a tick in my back, and I thought, maybe an office isn't so bad. Maybe air conditioning isn't so bad. And so I was trying to think, like, what else could I do? And so Texas A&M had a good master's in finance program. That was only 1 year post-graduation. And I thought, that would be good. And so I signed up for that, got into that. And I thought I was going to do more on the business side of a forestry company, like use my undergrad degree and just pair it with this business knowledge. But then once I got into that program, I found that I really liked finance. I liked the sense of scale. Finance affects a large, a lot of these corporations just have access to such scale, and their finance teams are typically relatively small. And so each person has an outsized impact. And so I felt compelled that I could do a lot in a single job just by having access to that sort of breadth of experience and opportunities there. And so once I was in that program, I just kind of fell in love with it and, learned a lot more about asset management and thought that specifically is what I want to do is this large scale institutional investing at scales that I couldn't fathom, like hundreds of millions of dollars, billions of dollars. And so I think the sense of scale is really what drew me into finance and more specifically into investing.
And do you have any stories when you were in school of things that were like, it's very different from forestry, right? So I'm just wondering, do you have any stories of things where you're like, okay, this showed me a little bit about what finance is like? Did you do any internships when you were there? Did you do any case studies when you were there? What helped you see the scale, I guess is what I'm trying to say. Before you got your first job, what was it like? What was your favorite part? What did you not like?
Yeah, good question. I think, so I did have an internship. I worked at EY doing structured products. And what that was all these apartment buildings, it's kind of complicated. And so I won't bore you with all the details.
Let's get into it.
but basically, all of these apartment buildings everywhere across the country have giant loans on them, right? And these loans are backed by the future rent stream of payments that they get from their tenants. And so what these apartment buildings do, not on their own, but basically what the finance market does is the finance market packages all of these apartment loans and basically pulls in 20, 30, 40,000 loans on individual apartment buildings and packages them all into one giant structured product. And it's really complicated. And I only did for 3 months, and I think it would take me 3 years to actually understand what was going on there. So like part of my job there was basically verifying some of the details of the tenants, and kind of doing like a quality spot check of the information that was being fed into basically the loan aggregator, to ensure that like not to ensure that there wasn't fraud, but like basically just to check data integrity. And like these loans were these package loans ended up being multi-billion-dollar or several $100 million loans that were then packaged and sold into the asset-backed securities market. And so like I think that was just kind of like my first introduction to like, okay, there's a lot of money at play, and like this is just one small part of finance. One really relatively niche part of finance is asset-backed securities. And just being able to work on like several multi-billion-dollar transactions there was really interesting. But I think I walked away from that thinking I don't want to be on the kind of support side of that. I wanted to be more on the front end of that, being the one to like make the investing decisions of, is this pool of loans a good investment for clients, for corporations, because someone has to buy these loans, right? And so I think that's when I was like, someone out there is buying these, and they're making like several hundred million, tens of millions, $1 billion decisions. How do I get to that? And so I think that's kind of what kind of opened my eyes to that, and kind of how I got my start thinking, just exposure to the sense of scale and what drove me to be more on the investing side.
What did you have to do to get into the program?
Basically just be smart. I had a really good GPA. So they were specifically looking for people that weren't finance undergrads. It was predominantly, the program is called STEM to Stocks. And it's predominantly people from a engineering background. And some people view it as kind of a substitute to an MBA program. So basically people that want that business knowledge, but have a very technical background. I don't think getting into that program was super difficult. But you did have to be a good student, come from a somewhat of a science background, technical background, because that program was more focused on like people that had like quant knowledge and could pair that with some business background. So good GPA, and then good test scores. We could either take the GRE or the GMAT. I took the GRE and did well on that and had a good GPA. But I think for that program, I mean, I think if you had like a 3.6 in undergrad, and I can't even remember what range of test scores there was, but like probably like, I don't know, top 25%, then you're probably going to be a pretty good candidate if you came from the right kind of major, which in my program was at least 85% engineering backgrounds.
And is this kind of opportunity widely available across the country? Like if someone wants to is from a non-finance background and wants to get in finance, do they have to apply to A&M, or do a lot of schools have this?
Yeah, it's a pretty new kind of thought, but schools across the country are really picking up on it. So now Texas A&M has it. The University of Texas at Austin has it. SMU has it. And those are just in Texas. Some of the better programs are at Duke. I can't really think of other kind of notable programs at the moment, but I would say probably a decade ago that there was maybe a handful of programs, but now pretty much most every major kind of flagship school probably has something very similar to it.
I know I already asked 2 questions, but I want to ask one more. So do you think these people with a non-finance background have a leg up, or are they kind of disadvantaged compared to people that did a finance undergrad and also a master's degree? What's the logic behind offering this program?
Yeah, so I'm super biased, of course, but I do think that people that come from a non-finance background do have a leg up, because in my experience, like finance people oftentimes tend to be too narrow focused, too focused on like metrics, on financials, and I think they often fail to understand the story behind things or fail to understand the bigger picture. And like, I think that's something that really helped me in my education and in my career so far. Is like forestry is very much like you do not care about details. You are very much a big picture. My timber company, I mean, we owned like 10 million acres across the US. Like if one tract of land got knocked out by some bug infestation or a natural disaster, like you just kind of don't care because you're so spread out and you're so focused on the big picture of just like, what is land management? How can I effectively manage large tracts of land? And I think there's just like a natural variability that comes from a lot of the kind of science backgrounds, like engineers. I think like say that you're building a road, like you have to take into account that some days it's cold, some days there's snow, some days it's 110 degrees. Like there's a natural variability that forces you to plan for a wide range of outcomes. Where I think a lot of finance students tend to be too narrow focused and too focused on precision rather than getting it in the right direction, which is good sometimes. Sometimes you do need precision. But, like at my company, we often make 30-year investments. I have no clue what's going to happen in 30 years. I can make an educated guess and get us in the right direction. But to think that you can have some sort of precision to that extent is arrogant to a fault. So.
And what are people in finance school like?
Very driven, pretty competitive. And I think one thing that I really appreciated about it was people were trying to be better than you, trying to be better than themselves, and trying to be better than their peers. And I think some people don't like that sort of competition. Some people get intimidated by it or just think that is not collaborative. But I don't necessarily think that. I think that it's only not collaborative if you're also not okay with knowing that there's stiff competition against you. And so I do think sometimes like people can take it too far and then it is kind of difficult. But I do think in general, you just have to be okay with thinking this person next to me, they don't want to get 100. They want to do better than me. And so you need to think, I don't care about getting 100. I just want to do better than them,
And you had mentioned that you're a CFA charter holder, which I think we were not aware of what that is. Could you go into detail of what that is and how did you get that?
Sure. So the CFA charter holder designation is kind of like the pinnacle of kind of on your own schooling, on your own certification to lead to a career in asset management and investing as a whole. And so what it looks like is it's 3 major tests that are all pretty hard. And you basically have to study the kind of recommended guideline is about 300 hours per test. And so it's a huge time devotion, but really it teaches you how to think about investing, how to be a good investor. And like, it also teaches you the quantitative methods that you'll need to do that. And like people often ask me like, is it worth it? Like 300 hours per exam is a lot. And over half of people fail every time that they take an exam. And so like a lot of people will study for 350 hours, fail, and have to do it all again. And so like people often ask me, is it worth it? And like, I don't really know the answer to that. I think it depends on what you want. If you're looking for the best return for your career, then no, it's probably not worth it. You're probably better off trying to network, trying to get into that job you want, and then solely focusing on doing that job the best you can. But I really wanted it to kind of know that I could. It was kind of a thing of personal pride, and to have credibility coming out of school, because I was a finance undergrad or a forestry undergrad and a 1-year master's in finance. And so I think a lot of people kind of looked at that resume and thought, I don't really know what's going on here. He's only taken basically 1 year of finance courses. Why don't we have someone that's taken 4, or someone from an engineering background that has the same thing? I'd rather have that person. And so I think coming out of school, it gave me a lot of credibility, showing that I'm dedicated to the field. I'm smart enough to learn it. And this is something that I actually want to do. Because I think a lot of people don't, they might think that they want to do it, but they really just want the job, the title, the money, and don't just have like a long-term passion for it. Yeah.
How long did it take you to start from the beginning to getting past all 3 levels?
Yeah, so it used to be that the test was only held in May once a year. And so then that would have taken me 3 years, assuming that I passed everyone. So they've now changed it to where I don't know, I think it's like 4 times a year or something, and you can take like the immediate next one. So I think the quickest someone can do it is 18 months or so. It took me 4 years because my test got canceled because of COVID. But I did pass all the tests on the first try. I took level 1 the summer before my master's program, and then I finished the last exam. So that was summer of 2019, and then I finished the last one May of 22. I can't remember the dates. I don't know. It took me 1 year longer than it otherwise would have because of COVID.
Gotcha. So you did CFA level 1 before your master's program, and then 1 right after you graduated, and then the 3rd one while you were working in your first year, kind of, more or less. Or second year.
Yeah. The second one, that one got delayed because of COVID. So yeah, that one I did, I guess, like 18 months, 2 years after I graduated.
Do people have to pass like any levels at all to practice?
So it's not, so it's it's kind of interesting because it's more of a bragging right, and it's not a barrier to entry. So like a doctor needs an MD to practice medicine. You don't need this to work in finance. It's unlike accounting where you need a CPA to like sign certain things, or a professional engineer that needs that stamp. You don't need this to do the job. Some jobs really prefer it, but it's not a barrier to entry.
How many people actually hold it?
Can we Google that and add that to the comments? I'm not sure. That's a good question.
So one question I have. So you interned at what was it, Accenture, or what was it?
EY.
EY. Okay. So then the master's program is 2 years. Is that correct? Or 3 years? Or 1 year?
So the master's program is 1 year.
Okay.
Yeah.
So then how do you what are all the options? You're in school, you do this internship, there's all these finance options, right? There's investing, there's, I'm sure, I don't even know what else, hedge funds, VC. How do you decide, what am I going to focus on? There's also probably consulting. Mm-hmm. And then how do you actually get a job?
Yeah. So let me step back and kind of talk about 3 major tracks that are kind of open to finance students. There's consulting, which is very popular because they need a lot of people. It's a high turn environment, and they like young, excited grads that are willing to travel and willing to work hard. And so consulting is a very viable track. And then there's kind of corporate finance, which is working at a company doing their financials, whether that's financial reporting or financial planning, saying car companies, they have to often think, do we build a new factory, or do we retool this one for the new production line, something like that. And so like finance is a large part of trying where to put corporate funds to get the highest and best use. And so finance is available at every company because every company has a question of what to do with our limited funds. So corporate finance, consulting, and then investing, I'll say broadly, because investing spans very widely from like public fixed income, public debt, to venture capital of super early stage startups, and hedge funds is somewhere in there, public equities, stock market investing. So like I'll lump all investing into just investing. And I think those 3 are kind of the 3 main ones. I think I think a lot of top tier students are really focused on consulting or investing. And I think the top tier of the top tier focus more so on investing. And I think those two are interesting to most people because they give you so much opportunity. You learn super quickly. You're thrown into a lot of different experiences, and you're expected to produce results in a way that's meaningful, and reliable. And so I think a lot of people go into those two industries thinking, I'll do this for anywhere from 3 to 5 years, get my experience, and then I'll jump over to the corporate world and either do like corporate development or corporate finance, but at a higher title, at a higher pay than I could if I went straight into that role. And I think a lot of people think like that because then they can, get the good experience up front, get great skills, great network, and but also work a lot, and then like kind of take that and transition into a corporate role where they work less, and make less, typically, but now they're at a much higher point than they would be if they started in corporate straight out of school. And so how to get there? Good GPAs. I think consulting especially, they're interested in kind of projects. There's like a lot of case competitions, things like that. I did consulting straight out of school, so I worked at Alvarez and Marsal, doing management consulting there for about a year. And I think they also look for personality a lot. They look for people that can get along with clients because consulting is very much a sales business. And so if you can sell a company saying that we can fix your problem, and look at these smart young people that we have and are personable, and like, don't you want them? And so I think it's personality, being smart, and being able to solve problems and not being afraid to make decisions, is kind of, I think, what consulting looks for. Investing, I think, is a little more quantitative in nature. It's less problem solving and it's more dollars focused. And I think that's especially true on like kind of the like top investing jobs such as hedge funds, and top tier investment banking. And there I think they're really looking for people that are super smart and just want to work hard, and just really want to learn a lot. And how to get there. I think consulting is easier just because there's a lot more consulting companies, and they tend to have higher amounts of staff. And so good GPA, personable, and a good experience, a good internship or two can land you at pretty much any mid-tier consulting company. I think if you want to go top three like Bain, BCG, or McKinsey, I think they're really looking for like that top tier student, like that 3.9 or higher, that near perfect SAT score, like someone that is just really, really smart and really, really polished. I wasn't that good. I did not get Bain. I applied. They didn't want me. So, I think that's kind of the difference between those two tiers of consulting. And then I think, and I think consulting broadly is open to a lot more schools. You don't have to go to like the best school in the state, one of the top schools in the country. Whereas I don't think that's true for investing. I think investing is much more concerned about pedigree. And so if you go to an Ivy League school, you're much better suited to work on Wall Street, to do top tier investment banking or hedge funds or something like that. My company is not that prestigious. And so we hire from state schools. We're also like in an off market. We're based in Dallas, not New York. And so like, the thought that someone from Harvard or any Ivy League really is going to like move from the Northeast, come to Dallas, Texas, where like we are kind of the best finance or like top 5 finance jobs in the area, is a much harder sell than saying, hey, come to New York. If this company doesn't work out, there's 1,000 others, So I think just geographically, I think we tend to be more open to other schools. And I hope that answers the question.
No, that was super good.
Very good.
And so you covered how to get in for like consulting and the different tiers. Investing, I'm not yet sure, right? Let's say I'm a person, I'm trying to get into investing. You kind of said, hey, it's harder. You kind of need more of a pedigree,
Yep.
right? If I'm at let's say a state school, how do I actually get in? Is it network? Is there case competitions? Is there investor competitions? Like, what do I have to do to get in? One option, I guess, CFA. What else is there?
So CFA is a great one because I think it just shows the dedication, the intelligence, and honestly, I think another one is going off market. Trying not to go to New York, but going to Houston, doing oil and gas. There's some in Dallas, and like being okay with not doing top tier investment banking or something like that right out of school, but going mid tier with the goal to get to top tier in a few years. Because I do think that the pedigree barrier is pretty large. And like companies are trying to get away from that because it leads to like super undiverse. I mean, finance as a whole is not a diverse bunch. It's pretty much all white males, just about. And I think companies are trying to get a handle on that, but it's very much like that. I don't believe that's a core focus. But I think what you can do is clubs. Pretty much every top tier state school has some kind of finance club, some investing club, some student run investment fund. So like getting involved in things that show your true interest, show that you're willing to put time on your own into it, I think is super helpful. We're interviewing for interns right now, and I think every single one that I've recommended to move forward is in their student run investing club or like their leaders in finance kind of org. So I think things like that just make you a better candidate for two reasons: because it puts you with other like-minded people, and it shows to a potential company that you are actually interested in this, motivated to do this. So anything on your own time, really, that shows you want this, I think is really good.
That is really helpful. And do these clubs exist not just in master's degree programs, but also in undergrad?
Yes. Very much broad, very much undergrad focused.
Mm-hmm. Yeah. I got a question from one of my friends who is actually in his freshman year, and he's interested in pursuing either a finance or just investing specifically profession. And he wants to know what advice you would give to someone in his shoes, in addition to maybe get good GPA and also study hard, potentially try the CFA, pass these tests, and also do clubs. What else can they do?
I think networking is huge. I think it's slightly more advantageous for consulting, but still huge in investing. I actually got my job because like I had known the person that I interviewed with. So I applied to my current company a total of 4 times, and I almost got it the time before I got it, but I was the runner up, and then they actually called me that next year and asked me to apply. I didn't even know that they were hiring, but the guy that I spoke with called me a full year later and like asked me to apply. And so I think just doing that, staying in touch with people, especially if you get interviews and think that you want to do that, stay in touch with them. And just, I think starting early is super helpful as well. This is not investing, but so this person from Bain, I had gone to a kind of coffee chat thing as a sophomore, and then again the next 3 semesters, and I saw the same person there, and I reached out to her several times and had several good conversations, and like she did what she could to help me and like put me in the best position to succeed. And so I think people want to help others get to where they are, and so let them help you, make them know you, be personable, be friendly, don't be overbearing. Don't call them every week, but like once every 4 months, just check in, see how they're doing, see if they have any advice for you. Just know people and have them like you, I think is really helpful, which is easier said than done.
Yeah, well, that is extremely helpful. So I think you've answered the question of like, what are the tracks and how do you get in? Why don't we talk about like your experience? What is it actually like to work there?
And let's start with a management consulting company, and
Sure.
Let's go into as much detail as you can to kind of like explain what that was like. Why did you move to investing?
Yeah, so yeah, my experience is very different than most. So I started there like prime COVID season. We weren't in office, we didn't travel, and we were way overstaffed. And so like I really wasn't put on many projects. I think that was the best year of my life. I did close to nothing and got paid for it, and it was pretty awesome. Every other company, almost every other consulting company had pretty major layoffs, and mine didn't. And so that resulted in us having way too much staff for few too many projects. And so, but like, what does it look like? I mean, companies hire consultants to help them with problems that they either don't have time for or don't have the expertise for. And so, like, some of the projects that I did work on was a company that was about to go through bankruptcy, and we were helping them evaluate contracts that were most advantageous to get out of during bankruptcy, and trying to evaluate the potential impact of that. And then another one was like classic consulting. They were moving their like primary finance, HR, everything kind of ERP. I can't remember what ERP, like enterprise resource something system like that. Like every back end function, like it's kind of like Workday, that like all their back end stuff goes through, and they were changing it from one major provider to another, and like they just don't have the time to deal with all the issues that pop up from that, and so they just need skilled bodies that want to do a good job in making sure that this gets handled well. Um, and so I think it really, the day to day is super varied, which I loved. And the focus is really on solving problems and just being a skilled hand that these companies can rely on. And so I think the biggest thing that I learned from that was like you can't make errors. Errors, like you're being paid to do a good job. If you do a slow job, that's one thing, but like you can't mess something up because no one else is going to check. They're trusting you to do it right, and it's super important to be 100% sure in what you're doing, even if it takes you a long time, even if you have to ask a bunch of people, even if you feel like you're not being helpful by producing enough. The quality over quantity was really driven home to me.
And one thing then that I would be curious about is for like the management consulting roles versus the investing roles. So I guess management consulting, what is the salary range for that? And both at the company you were working for and then also for like a top tier company,
Yep.
is there a big difference? And how is compensation even measured in general?
Yeah. So yeah, I started at Hours Marsal 20 2020. Yeah. And so I think COVID kind of altered the compensation structure at a lot of companies, and consulting is no different. But I had started, and like I had a starting salary of 70K, 5K signing bonus, and the target like end of year bonus, I think was like 15 to 30K. Hours Marsal had like a Y, and like that was first year. So like all in comp was kind of expected to be anywhere from like 80 to 100 or so was kind of the ballpark. Which I think after that the bonus got like much more variable, and it's very focused on like how many hours you bill. Hours Marsal was definitely more bonus heavy. They had a very entrepreneurial spirit, thinking if you want to go and work and do a great job, we're going to pay you for that. If you want to go and do fine and do exactly what you're supposed to be, we'll pay you for that as well, but just not as much. So I would think of them as kind of like a second tier consulting company, and then top tier. My understanding is they typically pay like 15 to 20, 25% more. So like first year at kind of the, Bain, BCG, or McKinsey, um, north of 100K, probably closer to like 115 or so. But my data is stale on that. Consulting companies very very easily share their salary, or not the companies themselves, but the consultants easily share their salary on Glassdoor and things like that. So that definitely has more up to date information. But yeah, big difference between top tier and second tier. And top tier definitely better if you can get it.
Can you tell us a little bit about what your schedule was like when you were a consultant?
Yeah, I mean, I'm a little hesitant to draw too many conclusions from that, just because mine, like we were very overstaffed. And so in general, I worked 30 hours a week. Like we were super overstaffed, or I think most consultants would say that they probably work close to 60. So I'm hesitant to draw too many conclusions from my 1 year there.
Yeah, it was COVID years. So it's not really representative.
Yeah.
And how did you decide to leave consulting?
Well, I think that was a big part of it. I was like afraid that they were going to think, why are we paying this guy for working 30 hours a week? And so I think I kind of felt like I had to leave. I wasn't on that many projects. I didn't feel like this is how I wanted to start my career. And like, that is not like, I was so sad the day that I left my company, because like, I loved that company. Like the people there were great. I would have loved to stay. But I think like COVID just kind of messed with my experience there. And I think I just wanted to do more investing than consulting. And I had the opportunity to do that. And so I took it. But I do miss Alvarez and Marsal. That their culture is great. People are fantastic. And I think that they had a really high quality of work standard.
Would you go back?
If I were to go to consulting, I would try to go to them. I don't think I want to go back to consulting, but they would be first on my list.
So maybe now we could talk about like why you prefer investing.
Yeah, and I think before we go into that, is there anything that you feel we missed in consulting as people who are not in consulting? Was there any part of your experience or your friends' experiences that is helpful for like the audience to understand about consulting, or do you think you covered it pretty good?
Yeah, I think the one thing that I didn't mention is like part of the reason that I wanted to do consulting out of school is that I wasn't too sure what I wanted to do. And consulting just gives you exposure to so many different industries, so many different types of projects, so many different types of people. And it really sets you up really well to do a lot of different things after you leave there. I left there and I am now doing private market investing, which I felt like would have been difficult coming out of school. And like, I feel like consulting, if you're not sure what you want to do, you might as well do consulting, because you'll get paid well, you'll get treated pretty well, and you will just have such a good skill set coming out of that. So I highly recommend consulting to people that otherwise aren't sure what they want to do.
One follow-up question on that. Do people usually stay in consulting, or is that like just a jump board, like a entry position that people want to get some experience in and transition to something else?
Yeah, I think most people do leave. I kind of understand the two main paths as do it for like 3 to 5 years and then go to a top tier business school, and then try to figure out what you want to do, or do it for 3 years and say, wow, I actually really like this industry, this company. And like typically most people leave to one of their companies that they're working on, which I think the consulting companies probably hate. But it makes the companies happy and their employees like it. So I do think most people view it as a temporary springboard. Mm-hmm.
One question from the audience: how does staffing work?
Yeah, that was something that I wasn't really prepared for. Is like you come in as a consultant, but you don't work for your company. You're an employee there, but you work for external clients that hire the consulting company and need skilled staff. And so like I was aware, but I wasn't really aware of what that meant. And so it kind of meant that you basically are constantly trying to get a job while you have a job. And so like every week I would meet with probably 5 to 10 of our senior leaderships and basically just trying to like try to pitch myself to them and say, hey, next time that you get a project, please call me and put me on this project because I need to do something. And so like you kind of have to pick who you want to work for and like make them think that you're a really good a really good resource and someone that they want to have on their team. And so like that was really odd of like feeling like I'm unemployed, but I have a job and they're still paying me. And so I think that's also like kind of something that I struggled with being remote. And like I am not the most extroverted person, which I think consulting generally has 95% plus extroverts, if I'm being honest. And I think just being remote and like being uncomfortable having to pitch myself to my employer was odd. But I think in general, when there's enough projects going on, it's typically the other way around. That like they're trying to ask you, do do you have any time to do this, this, and this, and you have to prioritize your time. But I was very much in the opposite camp of like, someone please put me on a project, like please hire me to your team, even though I work here. So that was definitely different. Yeah.
Listen. Yeah. And I think it's a good time to transition to investing. So maybe if you can start with telling us what was your first week like when you transitioned to Prudential?
Yeah. Yeah. First weeks are always something. So investing by nature is small teams, and small teams typically don't have infrastructure to support like bringing someone on. It's often an afterthought. Like, oh, gotta hire someone. They got to be there. And so training is not like, it's not structured. It's not like we have like, 50 people start at one time, like an investment banking often is. Investing is predominantly smaller teams. That's not true everywhere, but most places it's smaller teams, and it's really, really team dependent. So my first week was super stressful. My boss was in the middle of closing a deal, and I was hired on to be his team. So it was just me and him. And my first week, we were closing one major deal, and then that month we closed another one, and the month after we closed another one. And so it was like super stressful, high energy the entire time. I worked a lot. I had no clue what was going on. I was on the phone like 8 hours a day, sharing screen the entire time, like trying to do a lot. And so I think first week is hard anywhere. First week in investing on a live deal is super challenging.
What is the day-to-day like?
Very varied. So my day, I think my role is a little different than a lot of investing. I'm in a specialist role that focuses on power, and specifically we focus on power projects. And so for those of you that may not know, like power projects, they're not companies. They are shell corporations that have no employees. They have nothing, like they're not a normal company in any sense of the word. They basically are a legal entity that just own an asset, and that asset is a power plant in 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 my line of work. And so what that looks like then is that these power plants need maintenance. They need all this sort of fuel, anything like that. And so they contract everything out, typically long-term contracts with fixed price arrangements. And so a lot of what we do is read contracts and model it, because unlike Apple, Amazon, General Motors, like any corporation, like what's their revenue going to be like in 10 years? Like you have no earthly idea, right? Like so many different things could happen. Management could try something completely different. The iPhone didn't exist 15 years ago. But when you invest in a power plant in the middle of Ohio that has long-term contracts, in 20 years, it's going to be a power plant in the middle of Ohio with long-term contracts. And so we have the ability to basically take those contracts, put them into Excel, and say, this is the cash flow profile for the next 20, 30 years. And so that's kind of what I do, is I read a lot of contracts. I put those contracts into Excel, and it's basically just math at that point. It's saying, okay, I have a contract on this screen. I have Excel on this screen. It says that they have that someone has committed to buy power from them at $50 per megawatt hour. Okay, so I put 50 here, and then I read an engineering report that tells me how much power they're likely to produce in any given year. And I say, okay, power produced here times the $50 per megawatt hour equals revenue. And like we can accurately forecast revenue for 30 years if they have the contracts in place, which for our purposes, they almost always do. And so I think that's something that's really different about my job specifically, that like other jobs, even in my own company that aren't in this specialist track focused on power, just don't do. I think they do a lot more general kind of market research. We we as a company invest in mid-sized private companies, and like what is a gas station, like a chain of gas stations, like what is their revenue going to be in 10 years? No one knows. And so then you look at general population trends, just general idea to get in the ballpark. And so I had said earlier something about, I think finance people are try to be too precise rather than general direction. I think specifically in my job, I think oftentimes it's the opposite, is that we need to be very precise because we don't have employees. We don't have a backup plan. Like, it's a gas plant in Ohio. It's a solar farm in California. Like, it's not changing. And so I think precision is something different there. But that's what my day-to-day looks like often is contracts. I read a lot of contracts, and they're all very long, and they're all very legal, and I put that into Excel.
Is there like a law department that helps you like sift through these contracts, or are you like the law guy?
So I think that's different by company. A lot of firms tend to rely on lawyers a lot more than my company does. I think our view is that if you're going to be in a specialist group, you have to understand what you're doing. And if you're investing in power projects, you can't do that without knowing contracts. And so a lot of other peers, they tend to rely on counsel a lot more than we do. And so legal work is a large part of my job, and even more so, the more senior that you go. We do have 3 lawyers that support us and are available for questions, but we primarily use them on the actual like finance documentation of like our legal documents that govern our investment into the company, rather than the contracts that govern the power projects, kind of commercial transactions with others. It's more of a legal structure of how we invest into this power plant that they focus on. Which some days I hate. Some days I'm like, man, I could go work for a competitor and focus just on the fun stuff, not read these contracts, not do all of this legal work. But then I think like you can't be a good investor in the power industry without being good at law.
What's the fun part?
The fun part is anything that's not contracts. So modeling's pretty fun. Having a like trying to develop a view on so like some of these are fully contracted and some are partially contracted, and then sell into the merchant market for power. And so like trying to form a view on how power prices are going to be 10, 20 years from now, that can be kind of fun. Depending on market. And like some technologies don't lend themselves well to being contracted. Hydro, for example, hydro production is so variable that you're actually better off not contracting at all or contracting only a little, because otherwise what's going to happen is you're going to overpromise how much that you can produce, and then you're going to be short the market and have to pay prevailing market rates and be on the wrong end of that kind of contract. And that might be more info than people wanted. But I do think anything other than the law is fun. But the legal stuff, like mastering contracts and being able to turn that into an investment, is like there's no better feeling. So it's all fun.
And in your day, how many hours a day do you generally work? And which I guess what % of your hours go to each of these tasks?
Yeah. Okay. So how many hours a day do I generally work? So I think that's changed as I've progressed in my role, and my group has shrunk slightly. We lost a few team members. They didn't die; they just quit. And we've been trying to replace them, but it's always a slow process. So I would say my first 2 years, I probably worked 55 to 65 hours a week, probably closer to 55. So 11 to 12 hours a day. I would say like the past year, I'm probably closer to like 60 to 70, 75 hours a week. But if we're super busy, like I could work 15-hour days Monday through Friday, and then like 10 hours on Saturday and Sunday. So it kind of just depends on like we are very much deal focused, and so if there's a deal and it's taking up a lot of time, then it's taking up a lot of time. But if we're pretty quiet and there's no deal, like August, people go on vacation and the deals just kind of dry up, and everyone knows it because you can't plan a deal that needs a lot of people if people are going to be on vacation. So like August is a pretty quiet period. I would say then I generally work like 35 hours a week because there's just not that much going on. And sorry, it was how many hours a day, and then what percent of my day is doing what?
It's spent on contracts, Excel, fun stuff, not fun stuff.
Yeah, I think that you have to find joy in all of it. You have to think all of it is fun. I would say probably I always have several Excel things open. So do with that what you will. You could argue that I spend all my day in Excel. I would say it's probably realistically closer to like 60% of my time, and then probably 60% of my time as well just reading, whether that's and I know that's more than 100, but you can't read without also doing Excel at the same time, because
there's
like
some overlap in there.
There's some overlap in there. You can't like if you read it and you don't put it into Excel, then it didn't happen. And I spend a lot of time writing because we do it all in Excel, and it all culminates into basically like one output that fits onto one page in PowerPoint or Word. But our investment memos are typically like 50 pages or something. And so it's a lot of writing, a lot of describing the contracts, a lot of describing the projects, a lot of describing the area and demographics if that's necessary. So probably 60% reading. I'll bump Excel down to 50%, and then I'll add 40% writing. I have two screens, so it doesn't add up to
150%.
Yeah.
You have to work that hard if you're in finance.
I think it's more like these things are not mutually exclusive. So
Yeah, I got you.
Yeah.
So I'm curious, like how is a new project like acquired? Like
Yeah.
That question makes sense.
So let's talk about like goals for the group. So my group, I'm in the power group. We are tasked with doing $1 billion of new deals every year. And we have 3 teams. And each team is pretty much tasked with doing about $300 to $350 million of new investments every single year. And so at my company, we go out and find our own deals as well as take in deals that investment banks bring us. A lot of our peers don't do direct deals. Like they only take the deals that the market brings them, the market being investment banks that work with companies to basically develop a deal that they think is going to work to the market and just bring that to market. But we don't view that as enough because that limits our deal flow. And really what it does is it limits our investments to the same thing that our peers are investing in. And so then our pitch to our investors that like give us money to manage is you put money to work with us because we are giving you access to projects, to companies, to investments that you can't get anywhere else because we are out there making the calls. We are the ones talking to these companies and making the deal happen. Because if we're only going to invest in the deals that investment banks bring to the market, they might as well just go with any of our competitors. And then it's just a race to the bottom on fees, on things like that. So we're very much focused on direct origination, bringing deals out of nothing. And so like that looks like my team leader, my boss, my managing director, they like half of their job is marketing. Is like they actually go and find companies that are building new projects that have a fleet of projects, and they say, hey, how can we help you? What can we structure that you want? And so I think that's a core focus of my group is bringing deals to the companies and not waiting for deals to come to us. And so that's one way that deals happen. And then the easier way that everyone loves is some company goes to an investment bank and they say, hey, I have this huge portfolio of operating assets. It's going to be like $900 million or whatever. Can you basically make a deal, take it to a bunch of different investors and get bids? And then it's basically like the investment banks package it into a way that they think most investors will accept. And like, there's a lot of power projects. Nothing is new. People generally know what is going to happen in the market, what certain institutions are going to accept, things like that. And so that's typically an easier process where the deal is pre-baked and we just have to decide, do we want in or not? And so we do those as well, but they're just not as valuable to us as an asset manager because that destroys our pitch to our investors of why we add value to them, because otherwise they can invest with any of our peers. And so that's kind of how deals happen. But what it looks like is like we sort through a lot of junk, because if you're calling on basically every company that's building projects, you're going to get a lot of junk coming your way and say, we're just not interested in that. And so like I probably look at close to 100 deals a year. I probably turn down like, and like I say but I mean like my team, we probably look at 100 deals a year. We probably turn down 60 within about an hour of like there's some fatal flaw, or like the location's bad, this contract is like some fatal flaw just kills it for us. There's probably 40 that we take a few days on, and then we try to close about 5 deals a year, and try to do about $300 million spread across those 5 deals. So like closing a deal is rare. It doesn't happen every day, and it takes months to get it to the finish line. So it's a really good feeling, really good feeling.
For a deal to go through, like what stars need to align in general?
Yeah. I think it all goes down to contracts and kind of competitive dynamics. So we're really interested in long-term deals because our investor base is primarily insurance companies, pension funds, large corporations that want long-term fixed rate capital coming back to them to fund their known liabilities. Pension funds, I think, is the best example. Like if they know 20 years from now, or they can reasonably estimate that in 20 years from now they have to pay X amount to their pension, they need that return. And so we're really looking for long-term yield. And we often compete with commercial banks who look for much shorter term deals that are like 3 to 5 years in nature. And so we're looking like 15, 20, 30 years. 20 years probably our sweet spot. And so I think just tenor, just length of investment is probably the biggest one. And then like type of capital. A very important part of the investing we do means that they can't prepay it easily. And that has to go back to our investor base. They're counting 20 years from now that they get those funds. And the company might want to prepay it in year 5 if rates have gone down, if like similar to people buying a mortgage, if rates drop to 2% overnight, people are going to refinance their mortgage, pay off their old debt, and get a new debt at the 2%. We don't allow that as an investor, and it's really important to our investors that they're able to count on this fixed rate for 20 years. And so I think that's kind of a big competitive advantage, or a competitive hurdle that we have to deal with, is that a lot of the people that we're trying to give money to don't necessarily want to lock up this asset for the next 20 years if rates go down, or maybe they want to sell it. Like, these things happen. But like, other than that, I think we're really looking for long-term contracts that allow them to offload a lot of the risk to third parties in exchange for monthly services and ongoing fees. But like, those tend to be expensive, and project developers often want to do that in-house and like take some risk on, which is fine. But I think in general, we're looking for long-term cash flows that we can lend long-term debt against, which can be difficult across different technologies and different markets.
And I think I want to transition. I don't know if you have any follow-up questions. Is it okay if I transition, Ryan?
That's what.
So the next question I want to ask is salary. For investing as like a career option, what is the range that people get paid at top tier companies, at mid-tier companies, etc.?
Yeah, starting at the beginning of their career versus like mid level, and what's the ultimate?
Yeah, so finance is interesting because it's so bonus dependent that like it's hard to say what is comp, and I think it's also dependent on what type of finance you're in. Like private equity and venture capital probably pay the most if they're doing well. Otherwise, they pay pretty low. And a lot of the way that like they get their earnings, their comp comes from they get the ability to basically invest in the fund as well as the third party investors, and that often gets levered up. And so like if they get good returns in that fund, it has an outsized impact on their comp. But if that fund doesn't do well, they can get zero from that from that fund and just rely on salary, and maybe a small bonus. But it's really performance dependent. Um, and so like at my company, so it's also dependent based on like what type of capital you invest in. Like public fixed income is probably the lowest. Like starting out, I don't know, it's probably like just under six figures, probably like 95K or something. Honestly, not too sure, but that's more of a commodity style investing of like these are publicly rated by rating agencies, and you just kind of just have to decide like yes or no, do I want this? It's not a lot of like underwriting, a lot of like it's hard and it takes skill. I'm not saying that. But then like on the other flip side, there's like venture capital where there's some tech startup, maybe they work out and they'll be the next Uber, or maybe they fail completely. It's like the range of outcomes is so much dispersed that your comp is also so much more dispersed. And so I'm definitely most familiar, obviously, with my own comp and that of like private debt markets. And so like at my firm, you kind of start out, just over six figures, like 110 or so, maybe 115, and then like every year the ramp is very significant. And so like I've been there 3 years, and like my salary has barely grown, but my overall comp has become much more bonus focused. And so like my overall comp is up like 65% just in the past 3 years. And so like now I'm making like upper 100s, and like every year it's kind of about like a 20 to 30K increase or so. And then there's kind of like a there's like entry level of like first like 4 years or so, and then there's mid level, and then there's senior level, and there's a big jump at like each level where comp nearly doubles. And so like I'm almost at like the mid level, probably within the next year, and like at that point, like my comp is either going to go up to like mid 300s, or they're going to say, hey, thanks for working for us the last 4 years, but there's not a spot for you at the mid level. Go find something else. And which is fine. And like it's very much a pyramid where spots get less and less, just number wise. And so like at the top level, it's super, super performance dependent. My understanding is like, our team leaders, our vice presidents that have a whole team under them are tasked with investing, over $300 million. My understanding is like their salary is still under 200K. But their bonus is like anywhere from like a one times multiplier on their salary, or like a four times multiplier on their salary. So like the range is somewhere between like 400K to like over $1 million, depending on your performance that year and the performance of your investments. And I think it's kind of an interesting behavioral thing, because people either like save their bonus and live off their salary, or like they save some of their salary and just spend their bonus because it's like free money, and so it's just like kind of interesting how different people think about like bonuses, especially as it becomes multiples of your salary.
How many years is each level?
I think of them in buckets. So I like I think of entry level of really like 3 to under 5 years, and then mid level, maybe 5 to 10 years experience, and then kind of senior level as a dozen plus or so. There's definitely some overlap, in there, but that's kind of what I think of it as.
Since you're doing like really long-term contracts where you can't know what's going to happen in 30 years, how is your performance measured?
Yeah. So I think that's why we contract, or why we make the projects that we invest in contract everything. We try to invest in things that, on a long-term basis, that have strong contractual support underneath it, and think like it's hard to see external forces interrupting that contract. And so if there's not that strong contractual underpinning, we tend to not go long. So like I mentioned hydro earlier as an example of things that typically don't contract. So there it's kind of two questions. Number one is like, how long do we want to go? Last year or 2 years ago, we did a deal in Norway of a portfolio of 25 different hydro assets spread across Norway. And they had no contracts in place. It was just selling all into the merchant market because the Norwegian hydro profile is super variable depending on snow melt and rainfall. And so that one we only did for 12 years. And so like that's an example of us changing our investment strategy to fit a technology. And I think of gas turbines, gas power plants in the US in much the same way. They often have short-term contracts of like 3 years, 5 years, or they do rolling hedges on an annual basis. And those we think about how valuable is this plant going to be in 5 years and 7 years. And so we think about it less, less on like a cash flow basis then, and we think about it more as just how valuable is this huge plant going to be that can power 1 million homes. It's like it's probably going to be pretty valuable, but not as valuable as it is today. As the grid gets more modern, there's more renewables coming online. So we force them to pay down some of their debt while they do have these contracts in place to get to a point in 5 years and 7 years where we think at that point this plant is still more valuable than our investment is. And I think of those as definitely riskier deals where you don't have the contracts in place and you're more taking a view on the value of the asset at a certain point in time, because things can change a lot. And I think we've seen that in our gas deals. We've struggled. I won't get too technical about it, but basically, large plants in certain parts of the country are compensated in two ways. They're compensated on their ability to be dispatched into the grid, and that's called capacity payments, and their actual power output. And we predicted, the market generally predicted that the payment that they would receive on the capacity side of things would stay relatively flat. And that was a large part of our investment thesis, and that didn't end up happening. That cratered over the last few years. And so we have been really struggling with some of our investments that relied heavily on capacity payments, as have several others in the market. And so we don't always go long. We go long if there's contractual support. We go short if the technology requires it, such as hydro, or if the technology and contractual framework don't allow long-term debt, such as gas transactions.
Got you. And I know you work on a team, so like, and I assume you guys are all looking at maybe the same deal.
Mm-hmm.
Everyone analyzes it correctly. Like, how
Typically.
do you differentiate yourself from your teammate? Like, how do you know this person is doing better than this person?
People in finance tend to be pretty honest. So like, you will be told, hey, you're not as good as this person. This person is better than you at this. You need to look at what this person's doing and just do that. And I think like similar to what I had said previously about like finance students needing to be better than others and all that, whatever. I think that you just have to be okay with knowing you're not going to be the best at everything. Someone out there is better than you. but that doesn't mean that you can't learn from them and maybe one day be better than them. And it's pretty obvious working in small teams, working on the same deal, of where people's strengths lie and where people struggle. And I think especially as I've progressed in my career, like I now have an analyst under me, and like it's super obvious to me to be able to see where my analyst struggles versus where another analyst doesn't, and vice versa. Small teams and the same deal make it so that you can't hide your faults or your strengths. Like it is very apparent.
And what makes certain people thrive in this industry?
I think you have to want to know it. I think you have to be so intellectually curious that you can't stop. Like last week we did this super complicated structure of a deal, and there was honestly like over 1,000 pages of contracts, and like I read most of the I read a lot of the contracts, went to a lot of the exhibits, and you can't stop looking until you are satisfied that you understand how this works, how you understand like if this situation happens, then what? Where are you protected? Where are your risks? And being able to convey that and memorize that, and keep it straight in your head of, this is the risk that we are making when we put $1 into this deal, and these are the 3 ways that we're protected. So just an inability to stop looking until you have the answer to your question, I think is like what makes people like thrive in this role.
I'm curious what the life of like the people a little bit ahead of you look like, because they're probably older, probably married, probably have a kid or two. How does that work? Like, you have to put in all these hours. You have to have dinner with your kids. Like, what does that look like?
I wish my wife was sitting next to me and I could ask her about what she thinks of that. So the 3 team leaders in my group, they all have kids, and they all miss a bunch of activities for their kids, and they all very often choose work over their kids, over their families. They travel for work, they come home, they message us and they say, "Hey, I have to put the kids to bed. I'll be free in 10 minutes." And like oftentimes like their interaction, and like they all have nannies. They all have multiple nannies. That's kind of the running joke in the analyst corps is like 2 team leaders in particular have 3 nannies. And so like it's not, like when you think about the lifestyle that you want, I don't know that most people envision having 3 nannies. I'm not saying you have to, but you either have to have nannies or you have to have a stay-at-home spouse that does most of it. And even then, you might still need a nanny. But it is challenging. They work a lot. They work nights. They work every weekend. They work late. They work early. I think the key to success is sacrificing yourself so that you're available when others need you. And so like one of our team leaders, he gets up every morning at 5 a.m., works for a bit, and then gets his kids ready for school and stuff, sees them off. And then similarly at night, like works and then puts them to bed and works again. Like my boss works until midnight or later every night. Like he's always tired, but he doesn't miss dinner with his family. He goes to his son's soccer games, but he probably hasn't had 8 hours of sleep in 7 years. Like you sacrifice yourself to be there when others need you, whether that's work or family.
How do you feel about that?
I think it's tough, but like I think it's a choice that you make, and like it's a choice that you have to be sure that people in your life are on board with. Like me personally, like I have dinner with my wife every night, but I work most nights until either 11 or midnight. But like I make sure to not miss dinner, because like that's important to me to share that with the people that I care about. And, do I want to feel like I'm missing out on my kids' lives just for money? No. I think like the level of sacrifice that they make is not something that I'm looking forward to. But I think that's easy to say until someone offers you the exact choice to make like 750K or work late and get up early. It's like, well, maybe getting up early is not that bad, Like, it's easier to say now than I think it would be in 10 years.
And earlier you mentioned there's corporate finance as an option, which pays less but also has less hours. Is that some option that people go into from investing?
Yeah, definitely so. But I think I think most people make that decision about the mid-level when you get that first big promotion into like the mid 300s. Then it's kind of like that's the decision point of, do I want to keep on this super high earning, high trajectory path, or do I want to downshift intentionally? Make 200, like, still a lot. Like, I'm like, no one is starving. Like, make good money, but work less. But I think the mid level is when people pick their career track. I have not seen a lot of people, once you're in that senior role, I have not seen a lot of people willingly take a 70% pay haircut.
So even as a senior level, if you switch into corporate finance, you get paid in the 200K range.
I think the ceiling for corporate finance is much lower than it is for investing, unless you hit like C-suite kind of level, like that. But I think of that like less of like corporate finance and more of like business executive. Like, it's in a way a different field. But I like, there's a lot of money to be made as a business executive in a lot of different companies. But I think like corporate finance, other than CFO, tends to have a ceiling in the 300, like low 300s. But I could be wrong. I don't know every company's pay scale. I'm sure there's highly paid corporate finance people at a lot of Fortune 100 companies, things like that.
Looking at your path now that you have a little bit more knowledge, would you have done anything differently?
I guess gotten into investing earlier. I think like starting out of school, I don't have kids. I'm able to work a lot, and I feel like, this is a good time to work a lot and make a lot of money. I don't know that I'll feel that way in 2 years, in 3 years, next year. So I think I'm glad to be able to make the amount of money I do now, even if I do wish I worked less. And like, it's really not all about the money. Like I really generally like my job. I think being in the power sector is what drives me to it. Like, if I was in a non-specialist group that just invested in like middle market companies, I don't think I could do my job. Like, I don't have the passion for it. I think it would grind on me, and I could not put up with the hours just for the paycheck. Like, I don't feel like I'm getting paid enough to like not like my job. Like, I really like my job. I derive like personal satisfaction from feeling like our money, my investment decisions, my contributions help others and like help society. Just in the last few years, like, we've invested, I don't know, since I started, we as a power team have invested just under $3 billion. We've been a part of many new projects coming online. We invested several hundred million, or a few hundred million, into 4 large transmission lines, into energy from waste deals in the UK. There were 2 deals that we did in Germany. We invested a total of like $200 million, and now 50,000 homeowners in Germany have solar panels on their rooftop. And so like I feel like my group makes a positive contribution to society, and I feel good about that.
And people that are trying to break into the industry, what questions are they asking you?
I think a lot of people ask me, what does success look like? And I think it really just looks like being coachable, being better than you were the day before, and just asking a ton of questions. You have to be an expert in the things that you invest in. And so if you don't have that like deep-seated knowledge to learn everything you can about something and want to make as informed a decision as possible, I think that you can't do well. Like some people view it as like, it doesn't matter, let's just give them the money, like things are going to work out probably. But like you need to know every single thing you can about the market, the technology, the asset that you're investing in. And so just need like it. I think it's a personality trait of just having that level of desire to learn.
Anything else you want to say?
I think people just need to be generally aware that the culture in finance is harsher than it is in other industries, and like you can't take it personally. You got to think like these are people that are working really hard. They've missed their kids' soccer games. They were gone all week, and like sometimes people like yell at you and like say very mean things, and like I just ignore it. Like sometimes I tell my wife, and she's like, if someone told that to me at work, like I would call HR, I would cry, and it's like I thought nothing of it other than like the 5 seconds afterwards. I thought, wow, that person must be in a bad mood, and like that's it. Like it has nothing to do with you. That's like you're just at work, you're getting paid. Don't take it too personally. If you hate it, go find another job. Like it's your work is your work, but it's not who you are. And the people that you work with, they can sometimes be harsh, sometimes just because they're harsh. And if your company tolerates that culture, which a lot of finance companies do, then you kind of have to decide, are you okay with that or not? And I just ignore it. It has no bearing to me. It's like they didn't say it. Yeah.
Do you think it's because of personality or the stress?
Definitely both. I think definitely partially personality, predominantly personality.
It sounds a lot like law.
Yeah. It's not unlike big law. Yeah.
And we'll wrap up with this one because I know you have to go soon. But you strike me as someone like who's not super motivated by money. But there's a lot of money being made here. But I feel like there was almost like a sense of duty or something, like that you're somehow helping society by doing what you do. Like, am I getting that correct?
I think there's enough money to be made doing just about anything. And I think like we have a responsibility to use our talents well. And I think if you're top tier at anything, you're going to make a lot of money. So like I thought if I did forestry, I would probably do really well in forestry and make a lot of money there. And so like I think part of it is like I don't have to be rich. I do like money. Everyone likes money. Money is a big motivator to me. But like I think I could easily make more money now, or I think I could do something else and make less money, but still be just as happy. Like I think there's money to be made. If you're really good at something, people are going to pay you to do it well. So,
awesome. Yeah. This was actually one of the most fun interviews that I've done so far because there was so much that I didn't know about finance. So it was really nice having you on, man.
Well, thanks for having me. I love talking about power. I'm less interested in talking about finance, but I love talking about power. So thanks for letting me do that for an hour or so.
Sure, I'm a mechanical engineer, so we could talk power all you want.
Perfect.
Thanks a lot.
Cool.